February 2025. The Trump administration slaps a 20% tariff on Chinese goods, escalating tensions in the ongoing trade war. China retaliates fiercely, slashing U.S. imports while strengthening ties with Canada and the European Union. The result? U.S. farmers and businesses lose billions in market opportunities, while Canada and Europe capitalize on the shift. Was this a strategic miscalculation by the U.S. or part of a bigger plan? For decades, the U.S. was China's primary supplier of crude oil and natural gas. But by March 2025, after Washington imposed a 10% tariff on Canadian oil, Canada found a new buyer: China. Beijing immediately ramps up oil imports from Canada through the Transmountain Expansion (TMX) pipeline, increasing capacity from 300,000 barrels per day to 890,000 barrels. As a result, 50% of Canada's crude oil exports now flow to China, shifting Beijing's long-term energy reliance away from the U.S. Canada is also filling another key energy void: liquefied natural gas, LNG. The LNG Canada project, one of North America's largest LNG export facilities, is set to begin operations in 2025, with an export capacity of 14 to 26 million tons per year. Previously, the U.S. was one of China's biggest LNG suppliers. However, after trade restrictions were imposed by Washington, China shifted to Canada, Qatar, and Australia to diversify its energy sources. The result? Canada is solidifying its role as China's strategic energy partner, gradually replacing the U.S. in this vital sector. China cuts U.S. agricultural imports. China, one of the world's largest agricultural buyers, has sharply reduced its imports from the U.S. since 2023. Soybeans, once a key commodity, saw the U.S. share of China's imports drop from 40% in 2016 to 18% in 2024. Meanwhile, countries like Brazil and Argentina now dominate, accounting for 74% of China's soybean imports. Key crops like wheat, corn, and cotton, once staples of U.S. exports to China, are now being supplied by South American and European nations, including Spain and the Netherlands, who have become the new pork kings in the market. In fact, EU pork exports to China surged by 35% in 2023, while U.S. pork exports plummeted due to tariffs and stricter Chinese inspection policies. American farmers are suffering, with overproduction, falling prices, and declining profits. Smaller farms in particular are at high risk due to their inability to pivot quickly. U.S. industry loses key markets. It's not just agriculture that's hurting. America's industrial sector is also feeling the heat. Tech giants like Google, Tesla, and Intel are losing market share in China. Meanwhile, China is shifting its trade partnerships towards Canada, Europe, and BRICS nations. This shift is leading to a gradual decline in U.S. global influence, reshaping international commerce in favor of Canada and the EU, both of whom are capturing billions in lost U.S. trade. As U.S. farmers, tech companies, and industries struggle, the big question is, will the U.S. change its strategy to recover lost ground? Or is this the beginning of a long-term decline in U.S. economic dominance? If Washington continues to double down on tariffs, it risks further isolating American businesses from global supply chains. Meanwhile, Beijing's aggressive diversification of its trade relationships is fostering new alliances that could permanently reshape global economic power. The longer this standoff continues, the harder it will be for the U.S. to reclaim its lost influence. What if the U.S. president suddenly proposes that Canada become the 51st state? How would you react? Could this be a serious threat to Canada's sovereignty, or just an empty statement? Let's explore how Canada is responding to this, and what the potential economic fallout could be for both countries. In December 2024, during a meeting at Mar-a-Lago, former President Trump proposed that Canada could join the U.S. as two states, one conservative and one liberal. While this may seem like a joke, the comment deeply offended Canada's sovereignty. Prime Minister Justin Trudeau immediately shot down the idea, asserting that there's no chance Canada will ever become the 51st state. In response, Canada launched campaigns to boycott U.S. goods and tourism. Provinces like Quebec and Nova Scotia led the charge by removing American-made alcohol from store shelves as a direct protest against U.S. tariffs. This response highlighted Canada's firm stance on protecting its sovereignty. U.S.-Canada economic relations are at risk. The escalating rhetoric combined with U.S. tariffs, like the 25% tax on imports from Canada, has had severe economic consequences. In particular, tourism has been hit hard, as Canadian visitors to the U.S. sharply declined. With more than 20 million Canadian tourists visiting the U.S. annually, the loss of Canadian spending is damaging to tourist-heavy states like Florida, California, and Texas. The alcohol industry has been especially hard hit. Canadian provinces have called for a boycott of U.S. alcohol, and Kentucky's bourbon industry saw a major drop in exports to Canada. If this trend continues, the U.S. could lose billions annually in tourism revenue alone. What impact will this have on the U.S.-Canada trade relationship? Could these political tensions signal the breakdown of the decades-long economic ties between the two nations? Canada and China form an energy alliance, sidelining the U.S. As the U.S. faces its divisive energy policy decisions, Canada and China are quietly forging a new energy alliance, potentially reshaping the global oil economy. The U.S. announced a shocking 25% tariff on Canadian goods in early 2025, citing concerns over border security and illegal immigration. Canada's response was swift and forceful. Prime Minister Trudeau and provincial leaders have vowed not to remain silent in the face of this pressure. Some suggest that Canada should retaliate by imposing sanctions, but doing so could harm the Canadian economy, which is heavily reliant on trade with the U.S. One option on the table is reducing energy exports to the U.S. provinces like Alberta and Saskatchewan, supply a significant portion of oil to U.S. refineries, particularly in the Midwest and Rocky Mountain regions. A cut to this supply could drive up oil prices in the U.S., leading to economic turmoil. However, Canada's oil could easily be redirected to China, dramatically shifting the global energy market. China forms new oil alliances as the U.S. debates energy policies. China is diversifying its oil imports, increasingly turning to countries under U.S. sanctions, like Russia, Iran, and Venezuela. This strategy allows China to obtain oil at discounted rates, while reducing its reliance on Western suppliers. Moreover, these deals help China minimize risks associated with sanctions, while simultaneously applying pressure on other oil-producing nations. By shifting away from U.S. oil, China is positioning itself to dominate the global energy market in the long term. The real question is, can the U.S. maintain its dominance, or will it lose ground to China and other emerging energy powers? Canada's bold move at the NATO-EU summit. Canada has made a surprising move, shifting from defense diplomacy to economic competition with the U.S. During the NATO and EU summit, Prime Minister Trudeau announced that Canada is ready to compete with the U.S. in Europe. This isn't just a diplomatic gesture, it's a serious challenge to U.S. economic dominance. With a modern manufacturing industry, stable energy resources, and a growing aerospace sector, Canada is positioning itself as a key alternative to the U.S. in European markets. The CETA, Comprehensive Economic and Trade Agreement between Canada and the EU, is a gateway for Canada to deepen its trade ties with Europe. If Canada succeeds in diverting even a small portion of Europe's trade away from the U.S., it could have significant financial consequences for the U.S. economy. Can the U.S. respond effectively? Washington has two choices: increase trade incentives to keep Europe aligned with the U.S., or impose tariffs on Canada to halt its momentum. But both options carry significant risks. A strong response could push Europe toward Canada even faster, while doing nothing may mean the slow erosion of U.S. economic influence. Canada's trade power surge. As Europe increasingly looks to diversify its supply chains, Canada is presenting itself as a reliable alternative. If successful, Canada could emerge as a major global trade powerhouse, securing ties with both the U.S. and China, and challenging Washington's economic dominance in the process. The U.S. faces a critical crossroads. The world is watching closely as Canada steps into the global economic arena, potentially reshaping the balance of power. The next move could determine whether the U.S. retains its global economic leadership or finds itself sidelined in a rapidly changing world order. Canada, with over 20 million tourists visiting the U.S. each year, has been a massive revenue source for the American tourism industry. However, a recent boycott has caused the U.S. tourism industry to suffer greatly. If Canadians continue to limit their travel spending and purchases of American goods, the U.S. could lose billions of dollars annually from these activities. One prime example is the U.S. alcohol industry. Canadian provinces not only removed American-made alcohol from store shelves, but they also called on their citizens to support domestic products instead of imports. This has led to a major decline in the bourbon industry, especially in states like Kentucky, where their products were removed from Canadian shelves. This is just one instance of how political tensions can directly impact economic relations. The economic relationship between the U.S. and Canada now stands at a crucial crossroads. Political and economic tensions could dramatically alter the trade and tourism landscape between these two countries. So, the pressing question is, can this relationship recover after these challenges? While you've probably heard about the shifting energy dynamics between the US, Canada, and China, did you know that these recent changes could potentially shake the entire global oil economy? The US is facing divisive decisions in its trade relations, while Canada and China are forming an unexpected energy alliance, sidelining the US. This is a critical moment, and we're going to dive deep into China's oil strategy. why they're shifting directions, and what the US can do to maintain its position in this game. The US is losing allies, and Canada's actions are creating new momentum for China. A major turning point came in early 2025, when the US announced a 25% tariff on goods imported from Canada. The reason cited was concerns over border security, illegal immigration, and drug crime. But this wasn't just a simple trade decision. It was a powerful blow to the relationship between these two neighboring nations. The ripple effect was immediate. Canada's response was inevitable. Prime Minister Justin Trudeau, along with provincial leaders, voiced strong warnings. They made it clear that they would not stay silent in the face of this pressure. Some have suggested Canada retaliate by imposing economic sanctions of its own, but others fear that escalating tensions could severely damage the Canadian economy, particularly since Canada is so deeply reliant on trade with the US. As the situation unfolds, the question remains, how far will Canada go? Among the measures being considered, one serious option is reducing energy exports to the US. Provinces like Alberta and Saskatchewan provide a significant portion of the oil that fuels US refineries, especially those in the Midwest and Rocky Mountain regions. If Canada were to cut this supply, the US could face a serious problem. Oil and gas prices could skyrocket, making it harder for American consumers to afford these vital resources. But here's where things get interesting. While Canada would be creating trade tensions with the US, it could also be opening doors for other countries, particularly China. In fact, if the US were to lose its crude oil supply from Canada, China would have the opportunity to seize that energy source, which could dramatically shift the global energy balance. This situation raises an important question. What will Canada decide? Will they continue their long-standing relationship with the US, or will they forge a new path by partnering more closely with China? China, meanwhile, has been forming new oil alliances with countries like Russia, Iran, and Venezuela, all countries that are currently under US sanctions. This shift in energy strategy could disrupt not only the US's dominance in the oil market, but also change the entire global energy landscape. While the US debates its energy policies and trade relations, China has been quietly creating a completely different strategy. China is reducing its oil imports from the US and increasingly turning to countries that the US has sanctioned, such as Russia, Iran, and Venezuela. This isn't just about finding cheap oil. It's a calculated move to reduce dependence on Western markets. By securing oil from these sanctioned countries, China is able to obtain it at a fraction of the price, a deal that's hard to ignore. At the same time, this diversification allows China to reduce its reliance on traditional oil suppliers like Saudi Arabia, and most importantly, it helps minimize the risks associated with potential sanctions. This shift in strategy is saving China billions of dollars while also applying pressure on other major oil-producing nations. With more oil flooding the global market, countries like Saudi Arabia and Brazil will be forced to adjust their pricing strategies to stay competitive. This could have far-reaching effects not just for oil-producing countries, but for the entire energy sector in the coming years. By reducing its dependence on US oil, China is strengthening its position in the global energy market. The question now is, can the US find a way to maintain its dominant role, or will it have to face a shift from key strategic partners like Canada? The outcome of these economic and political tensions will undoubtedly have a major impact on oil prices and the global economy in the future. Meanwhile, Canada is creating a shakeup in US trade relations. The US, which has long been the world's #1 trade power, is now facing an unexpected challenge from Canada. The balance of power in North America may be shifting, and how the US responds to this challenge could set the stage for the future of global trade and energy. Canada's bold move, shifting global economic power. While Washington remains embroiled in complex trade wars, Canada has made a daring play at the NATO and EU summit, not about defense but about trade. Prime Minister Justin Trudeau sent a clear and unmistakable message. Canada is ready to directly compete with the United States in Europe. Could this be the turning point that alters the global economic balance? How will the US respond? Let's break it down now. Canada takes on the US. A bold move. When it comes to NATO's strategic trade partners, the United States has long been the dominant choice. But now a familiar player, Canada, is quietly and strategically changing the game. Canada didn't just show up in Europe for handshakes and diplomatic pleasantries. They came to negotiate, secure deals, and, most critically, compete directly with the US. Prime Minister Trudeau has delivered a strong and unambiguous message. It's time for Europe to reduce its dependence on American suppliers and consider alternatives. And who exactly is that alternative? Canada. But what gives Canada such confidence? Canada's competitive edge. Canada has outlined a series of competitive advantages that even the United States can't ignore. It boasts a modern manufacturing industry with advanced capabilities and high reliability. It holds abundant, stable energy resources, ready to replace U.S. supplies when necessary. Canada is also home to a booming aerospace sector, now becoming one of the most recognized in the world. At the heart of Canada's strategy lies the Comprehensive Economic and Trade Agreement, CETA, between Canada and the EU. This isn't just another trade deal. This is Canada's gateway to deeper access to European markets. If Canada succeeds in diverting even a small portion of Europe's supply chains away from the US, it would not just be a financial blow to Washington. It would be a direct strike at the heart of its global economic leadership. The impact on the US. Washington, as expected, was caught off guard by this move. Imagine the scenario. What if Europe actually begins reducing its imports from the US? Even a shift of just 5 to 10% of trade from the US to Canada could cost billions of dollars in lost revenue for the American economy annually. But this isn't just about the numbers. It's about the very foundation of US economic dominance. Washington has long held sway over global trade, particularly within NATO. And now a familiar rival could be changing the game. The question being asked by analysts is, did Washington underestimate Canada's strategy? Faced with this new threat, the US has two clear options. The first is to increase trade incentives to keep European partners firmly tied to the US. The second is to apply economic pressure on Canada through tariffs or trade restrictions to halt their momentum. But both options carry significant risks. A strong reaction could drive Europe toward Canada even faster, while doing nothing could lead to the gradual erosion of US influence in global trade markets. Canada's big play and Europe's response. This isn't just a test for Canada, it's a real power move on the global stage. European nations are increasingly receptive to Canada's proposal. Why? Because diversifying supply chains has long been a priority for Europe, particularly in light of ongoing trade tensions with the US. Canada offers reliable energy resources and is emerging as a stable alternative as Europe looks to broaden its energy suppliers. By strengthening economic ties with Canada, European countries can enhance their bargaining power in negotiations with both Washington and Beijing. If this strategy succeeds, Canada won't just be seen as a dependent trading partner of the US anymore. Instead, it could emerge as a truly independent global trade powerhouse with strong connections across the world's largest markets. This isn't merely a bold step forward for Canada, it's a direct warning to the US. If Washington doesn't adjust its trade strategy soon, it could see its decades-long dominance in the global economic order slowly erode. A story that's shaking not just North America but the entire world. Canada's surprising move, targeting Tesla. In another bold move, Canada recently proposed a 100% tariff on Tesla vehicles, a direct response to President Trump's trade policies. While this move targets Tesla specifically, it could have a far-reaching impact on the North American automotive industry and even on the global electric vehicle, EV market. Let's break it down. Canada opens doors to EU electric cars, a blow to the US auto industry. Canada and the US have maintained a close trading relationship for years, exchanging about $50 billion annually in cars, aluminum, and steel. However, under Donald Trump's protectionist trade policies, Canada has found itself increasingly squeezed. In a surprising twist, a Canadian politician recently proposed imposing a 100% tariff on Tesla cars. This could shake up the North American auto industry and have serious implications on the global market. Why Tesla? Tesla is more than just an American car brand. It's a symbol of innovation in the global automotive industry. Tesla currently commands around 70% of the US electric vehicle market, and its influence continues to grow globally. However, if Canada imposes a 100% tariff on Tesla vehicles, the price of each car could skyrocket by $5,000 or more. This would likely result in a sharp decline in Tesla's sales in Canada, as the higher prices would reduce demand and give other brands a competitive edge. The ripple effects would be far-reaching. The economic consequences of this trade war, investors in Tesla would feel the impact as well. With the company's revenue and profits under pressure, stock values would likely fall, sparking concerns within the investment community about Tesla's long-term sustainability and the future of the EV industry as a whole. But the consequences would not stop there. This trade war could disrupt the global electric vehicle market, which has been expanding rapidly in recent years. Other automakers and component manufacturers could face rising production and consumption costs, hindering the growth of the EV sector and delaying efforts to transition to greener energy solutions. This could directly affect global emissions reduction goals and environmental protection plans. Tesla in the eye of the storm. A broader economic impact. So will a 100% tariff on Tesla have a widespread impact on the US auto industry? Absolutely. While Tesla is just one company, its position in the EV market is significant. Tesla plans to sell over 1 million cars globally this year, with more than 50,000 of those sales coming from Canada. If a 100% tariff is imposed, the price of a Tesla Model 3, currently priced around $40,000, could jump to $80,000, far beyond what most Canadian consumers can afford. But the impact won't be limited to Tesla. The entire North American auto industry, including giants like General Motors, Ford, and Chrysler, would face major disruptions. Canada exports over 2 million cars to the US annually. If a tariff crisis erupts, factories could be forced to shut down, and hundreds of thousands of workers could lose their jobs. The Canadian auto industry alone is worth about $50 billion annually. If this trade war isn't resolved, it could cause significant damage, not just to Canada, but to the entire North American economy. The stakes are higher than ever. The bottom line. As Canada continues to challenge the US and shift the global economic landscape, the question remains, how will the US respond? With the world watching, the choices Washington makes in the coming months could have long-lasting effects on both sides of the border, and far beyond. This is a story of economic shifts, trade wars, and global power struggles, and the world is just beginning to see how it unfolds.